Hey guys, we're just chatting. Adam, Kaylee, how are you, Kaylee?
Nice to see you.
Looking like a movie star in them glasses.
I know, I love that.
That's me.
I know, I made Ben keep his glasses on for our picture yesterday. I'm like,
I saw that.
so cheeky.
Hey, Ian.
Hey,
Good, how are you?
good to see you in person again. You've been
Debbie,
out-
how was your concert?
it was one of the most fun nights of my entire life.
I'm
I was
sorry.
running
I
around the
missed it.
crowd and they were like touching my hand. And I actually felt like a rock and roll star. So-
That's amazing. Oh,
good to
I
have a
love
hobby.
that.
Hey, Adam.
That's so cool. That ranks pretty high then.
It was pretty good. Sydney was there with her sweet kids
Yeah.
and her husband.
Dancing babies.
Oh, yeah. And then we had some lady there, some like old great grandma lady in a bright green shamrock blazer and light up shoes, dancing. Thing ever. Yeah, it was a good time.
The crowd, huh?
Oh, yeah. Yeah, there was lots of dancing, the flashlight thing. It was like a real concert.
It's so fun.
Had to forget about, scenarios and numbers for a couple hours.
Yes, good.
My brain a break. How about
All right, guys.
that?
Should we get started?
Let's do this. You get to do
I
that.
didn't mean to like cut you off, but you guys joined us early. I love that. We're about 4 or 5 minutes after.
Let's do it.
CE class today. I'm excited for that, right? But the topic, home loan pre-approval, is kind of like the most important process in what we do, right? To set those expectations. Like my kids all bought homes when they were young age because this is all I asked them to do. Just go get pre-approved.
Yeah.
Because if they don't do that, then why are we even looking at homes? Why are we talking hypothetically about all these different things that could possibly happen? You gotta, like I said, set those expectations. This is where it all starts. And I'm sure you're gonna get some great takeaways for talking points with your clients and future clients. I mean, I would challenge you to just try and get people in your sphere and who you know to get pre-qualified. Even if they're not ready to buy or they're not really thinking about buying, just to kind of paint that picture and see what it looks like. My friend Eric has a friend up in Oregon, I believe it is either Oregon or Washington, that his whole business model is to get 20 potential clients in front of his preferred lender to get pre-qualified. And he sells, I don't know the exact number, but a lot of homes. I think it's actually over 100 homes a year. And that's his business model. I got to get 20 people in front of my lender every month. And that starts the conversation correctly. It sets the expectations. It's not just like first time home buyers. That's what we think of first and foremost sometimes. But what about people that know they should invest in real estate, but really just think about it all the time and don't do anything about it? Have Debbie give them a scenario. This is what it might look like for you to pick up that second property. You'd be surprised how many I've run into that say, oh, I can't buy another house. I can't afford 2 mortgages. I can't qualify for 2 mortgages. They think that they're qualifying for both payments or 2 or 3, in order to have that many properties because they don't know what they don't know.
Yep.
So this is a super cool class. I'm excited for it because it can lead to a lot of business if you focus on this and you actually share it and use it as a part of your business model.
It's true. I love that. We love education. Oh. Such a
Sorry. Okay, I'm gonna share your screen.
Yeah.
while-
Like you said, we love education. So like what he just mentioned is legit. Every single time I do a real estate investing class, it's 45 minutes. It's just the basics, but literally every time someone's light bulb goes off in their brain and they're like, oh, I didn't know I could do this. I didn't know the how. Again, they're just a lack of education, just like first time home buyers maybe thinking they need the 20% or all of those things. So this is a general overview of the pre-approval process today. Again, this isn't your job, it's my job, and I'm happy to answer these questions anytime. But the more education you have, the more credible you come across when you are talking to your buyers, when they do have some of these basic ideas, and it just helps you understand the process that goes into that as well. So that's why we do these. We're all about education. It just helps everybody do a better job because we're all on the same team, right? We might have different sides of the lane, but we're on the same team. And so I take I take some real estate classes and you guys take some home loan pre-approval classes. And so we're all doing better together so we can be more credible as an industry together. So this is a CE class. You are going to get 2 hours of credit for attending today if you fill out this form. So the QR code is here on this first screen, and then I'll do it again at the end if you missed it or just want to not be distracted by filling it out now. You can just write the keywords down, but that is how I submit your hours for credit. You're going to fill out 5 keywords because on Zoom, the division asks us to require you to have your cameras on so we can see your face, that it's you. And then we also throw out some random keywords throughout. There's no specific time. There's no specific words. That we're very random about it. That's how we know you're listening, because especially those who are on Zoom, it's very easy to get distracted, get on your phone, check emails, play video games, and I wouldn't really know. And so I do want to make sure you're actually getting the education. So we do have those keywords. I am going to call out 5, and you just need 4 of them to get credit. So 4 of the 5 keywords, and you will get credit. And there's a few other questions on there for some of the other things that we offer, like mortgage market update emails and other classes and things like that. So you can answer those yes or no, no big deal. And we'll just get going on today's class. All right, so the 4 C's of mortgage. These are the basics of what go into pre-approving someone. And of course, if you've attended any of my CE classes before, every slide I'm going to be asking you guys questions, seeing where you're at, seeing what you understand, and hopefully also eventually sharing some scenarios, going through some how to apply some of the things we're learning today. We like our classes to be interactive. So who can tell me what is credit? And why does it matter in getting a mortgage?
It scores your ability to repay debts, how financially responsible you are, or irresponsible.
Right, and it might be you use they score your ability to repay, right? So we have some people who take Dave Ramsey classes, which is great if you don't understand debt and money at all. But one of the problems we have with some of those clients is they come in and they say, yeah, I make $150,000 a year and I have no debt. And so you think they'd have a great debt to income ratio, and they do, but when we pull their credit and they haven't used credit for several years, their score is actually pretty low. And that's a problem. You have to be able to show the lender your capacity to repay this by having made other payments. That's how the credit bureaus calculate your score. So on one hand, you're saving a little bit of money, but it's going to cost you a lot if you have a lower score, if you haven't been building your credit score. And so we have a lot of ways that we teach people how to build their credit, how to fix their credit. We have in-house systems. If they have a low score, we have systems that will show us quick ways that they can do to get their score up. And then we have credit repair partners that are reputable. Please don't let your buyers use anybody that they find online. Some of those will actually destroy their credit worse and ruin their chances for years of being able to get into a home. So I'm not going to go into any more detail on that, because this Friday, I'm actually teaching another CE class on Zoom from my office on credit. So if you want more info on that, make sure you're on my emails and sign up for that. But there is a lot that goes into the credit score, and people do need to understand that sooner rather than later. We're always recommending, and I know a lot of you guys do too, get them into a lender to have that conversation, even if they're not thinking they're going to be ready for 6 months, 1 year, 5 years. I don't care. I like having these conversations. I'm not just saying only send me someone who's ready right now. I will work with anybody because I'm compassionate about their situation, and I'm passionate about education. And I'm in it for the long haul, right? I'm not going anywhere for the next 20 or 30 years. So I will have that conversation with them about their credit now. And we do have the ability to do soft pulls, which will not ding their credit. So we can have a general overview, or we can have them, if they're not ready to apply and pull a real report, I'll show them where and how to get their free report, and I can review that with them and let them know the things that they can do to build that credit and to the things that are holding them back. So anyway, I'll move on because we're doing more of that on Friday. Who can tell me what collateral is? Not Jeff. Jeff has all the answers every time I teach her. But it's great. We love that.
Be like a car.
Could be a car. Yes, a car is an example of collateral.
And I think you could sell.
Something you can sell.
Cash flow.
Gold's a nice piece of collateral if you've got some of that stashed away. So in regards to mortgages, collateral is simply the home. A car or other things like a 401k or gold would be considered assets. And we only have their assets on the application if they are going to use those to sell them to get a down payment or something. Otherwise, we don't care, it doesn't matter. So collateral for in regards to a mortgage is simply the home itself. And then capacity. What would capacity be important for in regards to getting a pre-approval for a mortgage? I know you know, you're just like, yep. What you can afford, basically your ability to repay, your capacity to make those payments. So that's where we will qualify them for what we call a max purchase price. We're looking at the debt to income ratios and their ability to make these monthly payments. And there are standards for those, and I'll go over that later. So it's their capacity to repay. We can't have people, and I have had this happen. People do come in and they show their rental income and say, well, I've been paying $2,900 a month in rent, so that's what I should be able to pay for a mortgage. That's not exactly how it works. We do have to qualify them by the loan guidelines, which tell us their capacity to repay, and it's highly regulated ever since 2008, right? So what would compliance be? Anyone else? Let's have someone on Zoom answer. What would comply? Why does compliance matter when you're getting a mortgage? Adam, I think you wanted to say something.
Call them out.
I wanted to say I have no idea. I don't know.
Okay, so compliance is just staying within those guidelines and regulations, right? We want to make sure we're not committing mortgage fraud in any way. So my job is to educate the real estate agents that I'm working with and the buyers that I'm working with on those guidelines and regulations so that we are staying in compliance. There are some sneaky workarounds that people do try to do to get a loan. And it's a good loan officer, any good loan officer is going to be making sure that you are staying in compliance so that no one gets in trouble later on, because I don't want to be, risking that person having mortgage fraud later on, or your license or mine, just to get a deal closed, right? So I'm going to always be making sure they understand all of the guidelines and regulations, just like someone saying, well, I can afford $2,900. Yes, but I have to calculate your debt to income ratio based off of your credit report and some other things. Or there's little things in our industry called like straw buyers, and it's like a fake person who said, they're using someone else's social security and something else like that, and it's a different person that's actually going to be paying the loan. Unless they're a qualified cosigner and qualified co-buyer. So we're looking at all of those pieces to making sure everyone is safe and protected and that it's a great transaction. All right, so residential lending is what we do. It seems like most of you are all residential agents, right? We don't have any commercial ones here. Okay, good. So commercial and residential lending are different. And here's some of the ones that a lot of people misunderstand. That can qualify for residential that can't. So obviously single family homes are bread and butter. That's usually what we lend on. We can also do condos and townhomes. And I'll go over the differences of those in a minute. And then up to 2 to 4 units. So you can qualify for a residential mortgage on a multi-family complex if it's up to 4 units. It's anything more than 4 that Fannie Mae and Freddie Mac consider that commercial. Yes.
Do you have to live in one of those units for that loan?
For FHA you do. For conventional you don't. You can get it. You can buy that as an investment. But for FHA, you do have to live in one. So manufactured homes and modular homes. Sorry, I need to turn that off.
Hey, Ian, Maybe what you mean is the type of loan you're gonna qualify for as an owner occupied, it definitely is gonna be lower down payment requirements, better interest rate. So yes, you would have to live into it if she's qualifying you as an occupant, but if you're just buying a residential property as an investment property, then
It
it's
will have a
different than
bigger-
that.
Yeah,
Mhm.
thank you. Yeah, I go into that more in the investment class, but yeah, it would take 20% down and it would have a higher interest rate, but 1 to 4 units will qualify as residential, even if you're not living there. There's a different loan products and yeah, different down payment and rates. So manufactured homes, modular homes, and mobile homes, who knows the difference? And who knows what qualifies?
Manufactured homes are permanently affixed to a foundation. Where a mobile home can be moved.
Yeah, so that is the difference. If it's manufactured, that's like a mobile home, but we consider it a fixed to actual real estate. Modular is stick built on site, but they came in sections, so it's different than a custom built home fully on site. They're a little bit higher quality, a little bit easier to lend on. But the manufactured homes that are on permanent foundations still have to be built after 1970. There was too many issues with them before then. Mobile homes are not residential property if they're not affixed to actual land. If they don't own the land, it's like a car. You'd have to get a personal loan on that. Let's see. Oh, and then residential homes that are in commercial zones. There are some of them that will still qualify if they've been grandfathered in and that we can get this rebuild letter from the city. So some cities are easier with that than others. So making sure you're checking with your lender on that property. If you have any little nuances like that, you can still put the offer in, but just make sure earnest money is not going hard until we can look into that for you.
Tell a little bit more detail what the rebuild letter is and how it affects insurance and stuff like that. Well, you mentioned it and blew by it really fast. Yeah. Sorry. So on the rebuild, if it's in a commercial zone, sometimes they're grandfathered in, but if, say, it burned down or something like that, if the city says once it's destroyed, you can't rebuild another residential property because it's in a commercial zone, then that's important for the lender to know, right? And it has to do with your insurance as well, so.
Yeah, okay, thanks. Yeah, so sometimes it's a yes and sometimes it's a no.
Would that be like any home that's in a commercial zone?
So if
You would
it,
want to check on that and make sure you got that letter.
any home in a commercial zone, you will want to check on that. So ask your lender first before earnest money goes hard or anything like that. If it's been burned down, my experience has been it's a no, but if it's still standing and in good condition, so depending on the city, it's often a yes still. So just, it depends on the city and the property and what has gone on.
Multi-zoning would probably be a little different, so if it's commercial, residential.
Yeah, so like a home that's been turned into a business, sometimes they won't let it be grandfathered back in. So again, it depends on the city and the property. So we have to check on that for you. So give us enough time before earnest money is going hard on that. And we can check on it before you even put an offer in. I just know we're actually getting back into multiple offer situations. My last 5 or 6 buyers have been outbid already, and Mike's too. So
What's the price range on those?
the newer, first time home buyer stuff, 350 to 500. All of them have had multiple offers that I've seen in the past few weeks, and same with Mike. So that's why we would want more time to do it ahead of time, but if you need to get your offer in, just give us time before the earnest money goes hard to do all of this stuff for you. Okay, so what is not going to work for residential lending? Commercial properties, what did you say, Terry, does storage units, things like that. Commercial farms. Now there are small residential farms, like I'm doing one right now. It's 5 acres, but it will work because it's residential. There's not commercial farms around the property. So when we get into the 5 acre to 20 acre range, this is where it's not so black and white. And this is the beauty of having our in-house underwriting. So I can submit things like this ahead of time and have the underwriter look at it for me to make sure it will work. When it's not so black and white. So we can do that ahead of time instead of while we're halfway through a contract or something.
So if there's any farm around the residential area, like, so say for instance, you have a lot and there's like a little bit cut out of that farmland where there's a couple houses on it, there's still farm on it? You have
If
to-
there's a small farm on theirs, it's probably okay. If they have a larger, if they have a 20-acre farm and it's zoned commercial around them, then the underwriter's probably gonna say this is commercial farmland. So, but that's one of those issues that's not so black and white, that why I love having in-house underwriting, because I can submit these things ahead of time before we're halfway through the contract. Land and lots that don't have homes on them, you can't pitch a tent and get a residential mortgage. You have to have a home on the property. Again, we already covered that. Anything over 4 units, manufactured homes before 78, and then again, I already covered mobile homes. Any questions on that one? Any questions online? I don't know if I can see the chat. Is there a chat? Oh, there it is. There's nothing on the chat. Now I know where to look though. Okay. Perfect. All right, who knows the difference between a condo and a townhome? Let's see, who else I know here?
Condos on their own airspace.
I know, doesn't that sound awesome? I'm in airspace.
Townhomes
Yeah.
on the ground.
Well, and thanks for reading ahead. So, I should actually do the slides like, have the stuff come up after. I'll fix that for next time. Yeah, condos basically just own the airspace. The townhomes are on the ground. So condos are usually stacked, townhomes are usually side by side, but not always. Occasionally we will run into something that's a little bit off from the standard. And the way that we verify it is actually looking up what the US Post Office has it listed as and the county tax records. So those are other things that we're looking at when we get into these kinds of units, because condos have more rules than townhomes, and we have to get more documentation with condos than townhomes, and especially with FHA and government loans. So we're looking at all of those things when people are buying those, when they're bidding on those, and the listing might just say condo on it, but we're going to look it up and make sure, or it might say townhome and we're going to look it up and make sure, because we've had problems where someone doesn't look it up and then it gets all the way through to underwriting and it's the other thing, and then we have a whole different set of guidelines and regulations we have to go through. And so when you have buyers that get pre-approved in the 250 to 450 range, we're having a conversation about HOA fees with you and with them. And I want you to send me every listing before you send an offer, because the HOA fee is going to determine their purchase price amount. So for about every $50 in HOA, it's $10,000 to $13,000 in reduction of their purchase price amount. And so we want to be looking at that for you. We don't want to just send you a letter, say, yeah, you can do $350, you're good to go. If you're looking at condos and townhomes, if it's a $50 HOA fee, then I'll say, okay, now we're at about $340, maybe $330. And then that may or may not still work in that situation. If it's a $250 HOA fee because they have an indoor pool and a tennis court and all of the things, then it's going to be a significant price reduction. So we'll always be having that conversation ahead of time with those average numbers so that you know when you're looking. And then always, if you'll send me the listing, I will type in the numbers of the HOA fee and calculate the taxes on that property so that we're where we need to be, especially when someone's right at their max. We just want to make sure we're calculating that ahead of time before you go under contract. Oh yeah, here's all the FHA stuff with condos. This is why they're challenging. If in condo buildings with at least 10 units, up to 10% of the units can be FHA insured. So the whole housing unit can't have more than 10% of them FHA financed. With less than 10, only 2 of them can have an FHA loan on them. So that can be a little tricky for people. 50% of the units must be owner occupied under FHA. The condo has to have adequate insurance and keep at least 10% of the budget in cash reserves. So we have additional documentation that we get from their HOA when they're buying a condo. We have to look at all of these in detail. At least 85% of the units must be current on their HOA dues. No more than 35% of the property can be for commercial use. So clubhouses and things like that are rented out. Every 3 years, the condo project must be recertified to ensure it still meets the requirements. So that's why condos are a little bit harder to lend on, especially if you have an FHA buyer. It can be done. I've done it, but we have more challenges. And so, we definitely want to be watching that and getting things in, documents in quickly. We want to be on our game on all of that. And then we don't, none of that is applicable for townhomes, which is why they're so much more desirable. But they're also more expensive, so it depends on their budget. So here's basically how it usually happens. They usually like you guys better than us. You have, your job is just as hard with all the things that you guys have to do, driving people around for 6 months sometimes and all the negotiating and everything, but it is more fun for them to talk to you usually about the home and their dream and the vision and how many bedrooms and bathrooms and the location and all of that. And so we kind of call ourselves the necessary evil behind the dream. Sometimes it's less fun to talk to a lender. So more often than not, they do reach out to the agent first through ads and things. Even when we've done our own internal Facebook ads, with Kevin or whatever, he's always saying, well, do an ad about a home and send the lead to one of your agents first, because that's usually who they want to talk to first. But not too much and not too long, because you do need to know what they qualify for before you waste your time sending them listings, driving them around looking. So you do want them to talk to the lender as soon as possible, but they usually end up talking to you first, only because that's the flow of things. They're interested in the house, and then, oh yeah, I have to pay for it somehow. So they'll talk to the real estate agent first about wanting to buy a home. Like your nephew, or not your nephew, it's a brother-in-law, right?
Well,
It's
it's
his
a
last
nephew by, their last name is nephew, but they're. Yeah, but it's my niece's husband, so,
Yeah,
but the last name is nephew.
Yeah, so they'll reach out to you and say, yes, I know this person in my family is in real estate and I'm thinking about buying a home. I should call you and ask you about it. And so they're going to talk to you about their dream and their vision and what their goals are for that. And then at some point in time, depending on your personality and theirs and how well you know them, you have to ask that question. Have you been pre-approved? Because otherwise it is not worth driving them around for 6 months only to find out that, they have a $50,000 debt on their credit report and they're not going to qualify at all. You don't want to be wasting your time and theirs. It's not just you, right? It's them too. We've had people who go out and look at properties that are out of their price range and they fall in love and they get all excited and then they come and get pre-approved and realize it's so much less than that. And now the things they're seeing are very disappointing and they're disgusted and they don't want to do it anymore. So it's an emotional thing for them as well, not just a numbers thing. So that's why it's just as good for them to get pre-approved first as it is for you. And so then make sure you have a lender that you work with, that like, and trust, that you can recommend for several reasons. First of all, a bad lender can kill your deal, right? If they're not doing their job, if they're not verifying income, if they're not running it through AUS, and then you find out these things down the line, somebody just told me they make $5,000 a month. So here's how much you can do, a pre-qual letter instead of a pre-approval. And then it goes, then you're under contract and you're going through underwriting and the underwriter says, no, they make $3,000 a month and they can't get anywhere near this. That happens. So you want to have, for your sake, you want to work with a lender like and trust, will verify everything, is very thorough, is getting things done, but also it helps them to know you have someone you trust. Because that's the scary part of the deal, right? You're like, well, I don't know who I can trust with my credit report and my bank statements. That's all of their personal identifying stuff, right? Their personal information that causes identity theft. And so it's scary in that aspect for them. And it's also scary for them worrying about being judged, right? They're like, well, I don't want just anyone looking at my credit report because then I have to explain why I was late on this one thing. And I don't want them to look at my bank statement and find out that I eat at Taco Bell every day and I might have a Starbucks addiction. You know, those are the things they are actually thinking about when they have to go and talk to a lender. So if you don't have a recommendation for them and you could just kind of leave them hanging to just find that out on their own, it makes it more scary and more unstable for them because they just don't know who to trust. They've heard horror stories too, right? So it really helps them for you to say, I'm a team, this is who I work with, this is who I like and trust. Even if you have more than one, just say, yeah, I've worked with this person and I've worked with this person, because there is different personalities too. So some people really like to just have one that they do everything with. Some people like to have 2 or 3, but do have a recommendation for them. It really eases that emotional fear for them and for you. So then the client calls the lender that you've recommended, and or sometimes they still want to use someone they already work with. Sometimes they're like, well, I'm just going to go to my credit union or my bank, and that happens too. So they're going to have this phone call, and the lender should be asking a lot of detailed questions. And this is the conversation now that you have an idea of, like, at the end of this class, everything that goes into a pre-approval. This is a follow-up call for you. Hey, did your lender ask you this? Did they discuss this with you? So when we're done here, you will have an idea of some follow-up questions to make sure if it's not a lender that you recommended and that you've already worked with, this is kind of how you can verify that it's someone who knows what they're doing and you can trust with this deal. Or you can say, hey, that sounds like a great pre-approval amount, but also I'm a little unsure that they haven't asked you this, that they haven't ran this scenario for you. Would you please just also give my friend a call? There's no pressure, there's no cost. And then you can have, you know, the ability to compare quotes or something like that, you know, but you can ask these questions as a follow-up to having sent them to a lender, or especially if they go to one that you haven't worked with before. So they're going to be filling out some questions. They're going to be filling out their application. Then the lender, along with the application, they're going to give them a list of the documents that are needed. I'll go over that in a minute. And then they're going to calculate their income and their debts and the down payment and the credit scores. All of that are going to determine the rates and the fees and what they can afford based on the guidelines for all of the different programs. So we're going to run all of those scenarios and find out which one works best for them, because it's not always so black and right up front. So we pull a credit score. If they're like, we have this little window of 680 to 700, where sometimes it makes more sense to go FHA and sometimes it makes more sense to go conventional. So we'll run both, and then we'll run both of those options by them and educate and let them choose. So then we'll go through the different loan programs that they can qualify for, the down payment amounts and how that's going to affect their rate, their insurance, their monthly fees, because sometimes people might have 100,000 or 40,000 or something, and they don't know if they want to put it all down or not. It's nice to have some reserves when, especially first-time homeowners, and they're not sure what's going to break down. What am I going to be responsible for? I don't have a landlord to fix things anymore. So it's nice to have some reserves, but maybe they need it all to get the monthly payment that fits their budget. So we're going to have all of those kinds of conversations with them and find out what works most comfortably for them. We will let them know the max that they can qualify for under the different programs, and then talk about their budget though. But just because you can qualify for 550 doesn't mean you want to, because we will give them a payment sheet and let them know this is your estimated payment in that price range. Are you comfortable with that? Some people are, and some people are not. And so we'll give them a pre-approval letter based on what they're comfortable with, but also let them know, but you can go up to this. So if you see something that's just above what you're comfortable with, call us. We'll run the scenario for you again with today's rates, because they are a little volatile this past year or so, and let you know where that would be and if you're comfortable with that. Any questions on that process so far? I mean, I'm going to go into all the details, but anything anyone wants to pause and say? Okay. Okay. I'm going to ask them, where are you looking to buy? Why do I care where they're looking? I'm not the one driving them around all over the state of Utah. You guys are. So why do I care where they're looking?
The areas might have special, like qualifications, or it might have special programs going on.
That's right. Different areas have a few different things. So for one, USDA is rural only. So if they're looking only in Salt Lake City, I'm not even going to look at USDA for them, right? The conforming loan limits are different in different areas. It's different in Salt Lake County than it is in Utah County, and also Summit County is one of the few in the nation that has a higher conforming loan limit. So we're going to be looking, and then there's some grants for first-time homebuyers, but they're by city, and so they're not, there's Provo and Orem are pretty good about those. Everywhere else they come and they go. So that's why we want to know where they're looking, to just kind of vet out those different programs. Do you have military experience? Anyone knows why I care about that?
Yeah.
VA, exactly. That is the best loan program. They are going to have the lowest rates and fees. And there is an upfront funding fee on those unless they have 10% disability. If we get that letter, then there's no upfront funding fee, and it's a true zero down program, and it has the best rates and fees. And so we're always going to be seeing if they have some military experience. They
What
cannot.
letter are you talking about?
Hmm?
You said if you get that letter, what letter?
Oh, this shows that they have 10% of disability.
Oh, okay.
So that will be in their paperwork. We'll ask them, they know if they have that or not. And I do have one person that didn't know, and he applied for it. He's been working with the government to get it for about 8 months, but usually they already have that.
Okay.
But they do have to prove that.
And
that
that's
is a
only if
process.
you have that you get the zero down.
It's always zero down. VA
Oh, for
is
VA,
always
thank you.
zero down, but there is a funding fee. It is called an upfront funding fee. It's smaller the first time they use it. It's a little bit more the second time they use it. But that is waived if they have a 10% disability.
Gotcha.
It's included in the loan, so they still have, it's a zero down. They just have to pay closing costs either way, whether they have the upfront funding fee or not. That is included in the loan. It's kind of like the VA's version of mortgage insurance, but it's much cheaper. What is your time frame? So I also want another time frame, just like you. I mean, if they're not looking for 6 months for a year, are you going to go start driving them around today? Probably not, because those homes will no longer be available. So same thing for us. If I get someone who's not ready for a year or 2 or 6 months or whatever it is, then instead of pulling their credit now, there's no need to do that. So I can have them get a free credit report. I can give them a review of steps to get in the best possible position for when they are ready. I love having those conversations ahead of time because it always helps them get a better loan when they are ready. They don't have to wait to talk to a lender until they're ready to apply. Just if they know they're going to be interested eventually, is anytime they want to talk to someone and just get that education, or just come to one of the home buyer classes we do every month, or you guys do. So we want another time frame because that is going to be an educational call, or is it going to be a pre-approval call? And then again, knowing their budget. Just because they can qualify for $650 doesn't mean they want to. They might have more of a lifestyle where they love to travel. If they love to travel 4 or 5 times a year, they're going to want a lower monthly payment and a smaller home. Sometimes people are homebodies and they want the biggest, best possible home that they can afford. So we will max them out. It just depends on their goals and their dreams. So we will also talk about their budget by asking them, what their monthly mortgage payment that they want to stay under, and we will talk to them about the price ranges that will be in that area. We need to know the down payment amount because that's going to affect which loan they can get and where it's coming from. We do have to, I'll go into that in more detail on another slide, but the down payment amount, who knows the minimums for the different programs? It's okay if you don't, because that's my job, not yours, but I know you know. What's the least you can get in if you're not doing VA or USDA, if you're not doing a zero down program? What's the least someone can get in for?
So 3%?
3% for conventional for first time home buyers. USDA, VA are going to be 0 down, and then Utah Housing will work for a 0 down for conventional or FHA. Utah Housing will work for both of those.
I heard that this might be changing.
That's not changing.
Okay.
FHA is lowering the mortgage insurance, which is amazing. People can
Okay.
qualify
Maybe
for
that's
a
what I
lot
saw.
more. And then also Utah is passing a bill sometime around July 1st to offer $20,000 towards first-time homebuyer grants. The details on that are slim. It's only for new construction. It does count for condos and townhomes, and that's about all the details we have at this time. But I will now let you know. Stay tuned. We'll be watching that as closely as you guys are. Again, we need to know how much or what do they do for work and what their monthly income is. And this one is, I'm always asking gross before taxes, because most of the time when people are asked how much they make, they answer their net, which is a huge difference in what they can qualify for. And so when I get to tell them, oh no, it's gross, they're very happy because they get to qualify for a whole lot more off of gross than they do off of net. So we're taking those initial conversations, but of course, when we get their pay stubs, we verify that as well. So all of these details go into what we're looking for, the different loan programs. So in addition to USDA, VA, conventional, and FHA, those are our in-house products. There are non-QM products that are not backed by Fannie Mae and Freddie Mac. I'm not going to cover those today, but if you ever have any scenarios that don't fit into what we're talking about today, DSCR loans, investor cash flow loans, no doc loans, bank statement loans, they are still a thing. If people have a 20 to 30% down payment, they can do some true no doc loans and a decent credit score. So we can talk about personal scenarios in great detail later. If you have anything that came up for you today, whether these or that, I'm always happy to take your calls, just like I am talking to the buyers.
Do you want to do a keyword?
Thank you. Yeah. Okay, yeah, we're like, thank you. Keyword number 1 will be shortly followed by keyword number 2. Keyword number 1 is FHA. So you guys just write that down, keyword number 1, FHA, and then you'll fill that out at the form at the end. And remind me in like 5 minutes. Okay, any questions so far? Doing good? No chats at all. You guys are quiet online. Okay, so these are the things we want the buyers to be asking us as lenders. They need to be, and these are the things that you guys can prepare them with. Say, this is what you need to be asking your lender. If they're not already covering these topics, this is what you need to be asking them. So which loan program is best for me and why? They deserve to be educated, right? They need to understand. I don't like it when they go, I hear stories about them going to specific loan officer and just saying, well, here's what you need, just this one product. I want them to be educated so that they don't come back to you 2 years from now saying, hey, why didn't you tell me that I could qualify you for this or this or this? Why didn't I know all my options? This is why you want to know who they're working with, because you want someone that's going to present all of their options. I was actually here preparing for a C class one time when I got a quote from someone else from a specific credit union who peddles one product. And I took their quote and I said, well, just let me see what I can do. And I ran a few scenarios, and within not even 10-15 minutes, we showed them a product that was just a traditional loan that they didn't have to do this one product. I'm like, here's one you totally qualify for, and it will save you $150,000 over the life of your loan. That's substantial because they did plan on staying in that home long term. This was not like a temporary housing thing. This was like their place they wanted to raise their family and be there. So that's a substantial amount of money. So you want to make sure that your lender is going over the different loan programs with them and why. They deserve to be educated so that they don't, again, 2-5 years down the road, realize, hey, I didn't know about this and this and this. Why didn't you tell me? That cost me $20,000. That cost me $50,000. That cost me $150,000. We do not want that happening. We want their best interests all the time, right? Fiduciary duty. what is my credit score? So when we are just doing the questions, the overview, I won't know that yet. But when we do the actual pre-approval, we do have to pull their credit. We will have their score, and I am happy to share and review that with them. I can't share it with their agent unless I get permission, and sometimes they do want that. Sometimes they want to, so, you know, you're the friend or the family member that they trust deeply, and sometimes they do want to have that conversation with the agent. So I can sometimes get the buyer's approval to share those details with their agent, and we do have that happen sometimes. I have a call at 3 o'clock today like that. So we'll go over their credit scores. We'll go over the things that are making up those scores. If they're really close to qualifying for a slightly better interest rate or better loan, I'll talk about what they can do to get there and how long that takes. So traditionally, yeah.
I've got a question on that credit score. I speak to a lot of people who are like, don't even know if they're gonna qualify, a lot of first-time home buyers who are trying to get there. And is there anything ethical surrounding me? Well, what's your credit score like?
You
Me
are
asking.
You are allowed to ask if they want to tell you. The only thing you cannot discuss ever are interest rates. A lot of this other stuff you can discuss, but it is a thing of staying on our side of the lane, right? It's like just like me talking about property details. Technically I can, but I usually always say, well, that is a great question for your real estate agent. That's really more their side of the lane. I really handle the financing.
So
But you can get educated on that. And again, I'm going to do a credit class this Friday so that you'll have more of those tools and more of that knowledge, and that you can understand the basic overview of the 5 things that go into making up their credit score and the things that they can do to get it up quickly. But your lender's the one that can give them the details of that, because that's what I do, right? So I have the system. I know exactly how much they owe on each card. And like if this one's at 25% and then this one's at 35, well, I know if you just throw 200 and get this one down to 25, it'll bring your score up 50 points. You know, I know those things because I can see the details, and that's my job. And I have a system that shows me all of that, right? So it's more helpful to have them talk to the lender, but for you to have the idea, if they're resistant to talk to a lender, for you to have the basic knowledge is helpful. Absolutely.
okay, I mean, you touched on, you know, I can't discuss interest rates, right?
Right.
So, and that's the question that always gets asked, hey, what are the interest rates like?
So you can pull up my email
What's
and
that?
say, my lender says.
Sometimes I'm quoting from that,
Yeah,
and I get like so many of those emails. It's-
yes. So you have several, yeah, and they all should be pretty similar.
Yeah.
If you do see one, if you see an email or a billboard that's substantially lower than everybody else's, I guarantee you they are including a buy down fee. And to me, that's unethical.
Yeah.
If you are just claiming your rate is so much lower without in the advertisements also saying, well, that's, yeah, I can get it, I can get you any rate for $50,000. So, but for us, we do not think that is ethical. So we are always quoting the par rate with no buy down fees. And then we're always talking to them at this conversation and when they go under contract. And again, halfway through the loan process, what it looks like to buy down your rate, the exact amount that it costs, the exact break-even point. So if it's $1,500, how long do you have to spend? What does it do to your monthly payment? And how long does that take to break even? Are you going to stay in the property this long? If so, it makes sense. Unless we're in a volatile market and we're looking like rates might drop anyway, then it's not worth it because you would want to refi and not spend the money doing this. So we're having all of those conversations with them about the buying down the rate and the different rate options. That's included in our service all of the time for every single borrower.
If you're having that conversation, like before you're actually starting to work with them and stuff like that, that's just a perfect introduction to get them to a lender, because it varies so
much.
much that they have to watch it daily. Throughout the day, it can fluctuate, right? So just kind of point them in that direction, and then that will become their source, but always cite the source, like Debbie said. But best situation is just get them hooked up.
So you can pull up any of those emails. You can pull up Mortgage News Daily, which will give the par rate as well. You can access that and show them that. You just can't quote rates yourself without sourcing it, like you said.
Right.
And then also understand that not only do rates fluctuate daily, even throughout the day, but so does the buy down fee. So the amount it costs to buy it down also is fluctuating throughout the day. So when we have that conversation with someone, when we get their contract in, we let them know that as well. See, this is the quote that we can give you right now. Even later in the day, this might be different. If you wait till tomorrow, this is going to be a little bit different. And we do have people who sometimes want to float the rate. So we get the contract in, we can start the loan without locking the rate. That's not what we prefer, especially in this market, because if they're maxed out and then the rate goes up, and then all of a sudden that's a deal killer, right? So we're asking, and we did float the rate with one of your people, but it was a different market. It was a downtrending market. So it was good that they did that. They actually did save some money doing that. But again, we're educating them and having that conversation about, and we never recommend, we just say, this is what's happening, and here's some resources, and here's some further, especially if they're floating. We can't recommend them to float, but we will educate them on market trends and let them decide. But usually they lock when we get the contract. Yes. Oh, keyword. Credit. Keyword number 2, credit. You guys all still hear me all right online? Thumbs up. Yay. So yeah, so I can't actually either. I can't give them my version of the credit report. It is a mortgage version. It's not the consumer report. So when people ask for that, I can give them their score. But I can't give them my report. But after their credit's been pulled, they can get another free report. So I will always give them that resource as well. Credit scores to get the best deal. So that varies by loan product. So for conventional, 740. Anything above that, I mean, scores do go up to 800, but 740 is going to be your very best. 740 conventional is going to give you your very best rate, and then and if they're not putting 20% down, 760 is going to give them their very best fees on the mortgage insurance. For FHA, the best score is 720. How much do I need for a down payment? We already covered that. It's 3% if you're a first-time home buyer. For conventional, it's 3.5 for FHA, and then it's 5% for conventional. Unless you want one of the 0 down programs. And I'm going to review that again, because I don't think I covered the difference in 0 down. USDA is a really great loan. It's hard to qualify for because they have the tightest DTI. VA, really great 0 down program. Utah Housing is the last resort. If they don't have a down payment, we will look at that for them, but it drastically lowers their purchase price because it has higher rates and fees. The less somebody's putting down, the higher risk the loan is to the lender. The lender is not in the business of buying houses. They don't want to have a buyer that's defaulting and then they have a house at 100% loan to value, right? They don't want that. So it's going to have higher rates and fees. However, we will still show them, at the current rate of appreciation and things like that, how it is still better to get in now in a starter home. Even if you have 0 down, it might lower your purchase price a little bit, but it's still better to get in, build your equity, and you can refinance later on down the road when you qualify for something better, when you have enough equity in your home, when you've been in there long enough, or when you're ready to upgrade. So we will have the conversations about that, because 0 down Utah Housing is not a magic pill for someone who doesn't have a down payment. We are going to educate them on the fact that it is more expensive to do that, but it's also still worth it. So just so they know what they're getting into.
What was the FHA rate?
The rate?
So you said 7.
Oh, the minimum down, 3.5.
720.
Oh, the score.
The best.
Credits for the best rate.
Rates, scores, all these terms. I think I basically covered all that. Oh, how long does it take to do a loan? Okay, so that depends on your lender, right? Some of them are more slow and are 45 to 60 days is what we were seeing last year with some people. That's terrible. So we're in-house, so everything our typical turnaround time is 21 days. But we do our Security Plus program. If we underwrite someone ahead of time, we guarantee them to close in 10 business days or less. But your standard for Utah is 30. And then also when they are applying, we're going to give this to them. It's an example of their payments or their estimated payments. So we will type in the max purchase price up here at the bottom. And then we will type in the current rate, and we'll estimate the taxes and insurance based on where they're looking and things like that, to give them an estimated total payment and the different price points. So say they can get a max purchase price of $550, but they're not comfortable paying $3,000. So we give them this chart so they can look, okay, actually I want to be around $440 because I want to pay around $2,400. I can't give you guys access to this because we fine tune it every single time. So we're looking up the tax records and we're looking up, there is different things that go into their PMI, credit scores and down payment and things that are going to adjust this. So we'll do a new one for every single pre-approval. Now we do have to collect their personal information. So these are the things that when they're talking to a lender, this is why it helps to have someone and you refer to. They feel more safe because they are giving us their name, their birthday, their social security number, everything but their firstborn child is what it feels like by the time they're done. And it's stressful and frustrating sometimes for people to have to come up with all of this, and they're hesitant sometimes, not always, but a lot of times, especially first-time home buyers, they're scared. They don't understand, and they're like, what is this person that I've never met going to do with all this? So we're happy to get on a Zoom call, meet them face to face, whatever we need to do to help them feel safe and secure and taken care of in this whole process. And then we're going to ask them about their job history. Now this one is fun. This is one that has a lot of misconception around it. So 2 years employment history. Does that have to be at the same job?
I thought it did too.
Probably the same industry.
It depends on the work, doesn't it?
Yeah, so it no
Then
longer.
if they're self-employed, it has to be 2 years.
Yeah, so we need, bottom line, Fannie Mae, Freddie Mac, whatever loan we're doing, there does need to be 2 years employment history. Now, it doesn't have to be in the same industry anymore unless they're variable. And then we have to show a year history of that. So there's a lot of things that do go into this. But if we have someone who worked when they were in their early 20s, and then they were a stay-at-home mom for 10 years, and now they're back on the job and they've got one paycheck, they haven't worked for 10 years, then we qualify them. Nobody knows. This is why
Yes.
Yes, we can, because we still have a 2-year history. So anything over a 6-month gap, we just have to be able to explain. But if they have a 2-year history, and even if they have a 7-year, 10-year gap, but they've got on a new job and it's salary and they've got a contract, we're good. We just need one pay stub, or even the employment contract. I've qualified people just off of the contract before they even have a pay stub. If it's hourly, we can also do it off of one pay stub if we can guarantee they're going to get 40 hours. If they're hourly and it's dipping, right? There's sometimes they're 40, but sometimes 37 and sometimes 27. They're going to go into what is called variable income territory. And so that is different. We are going to have a 1-year history. So if there's a long gap like that, they have to be back on the job for that kind of situation for 6 months. And if it's variable, it's going to have to be a year. So there's different scenarios. And again, this is why it's so helpful to have in-house underwriting, because if it's sketchy like that, I can submit it and say, is this going to pass? And they can let me know.
I'm sorry. Does this only apply to first-time home buyers, though, the 2-year employment history?
No, anybody. Yeah.
Okay.
So anything over a 6-month gap, we're going to have to explain. They need to be back on the job for 6 months to a year for FHA, and then if it's variable, 6 months, and then a year if it's variable income. And variable income isn't just hourly that they dip. That's going to be things like commission jobs, piece rate jobs, things like that. Debts and assets. So yeah, I don't really need them to fill that out on the application, because if they actually want to get if they just want a quote, I do need to get all that from them, but more often than not, they forget some of the things. So I just barely did a quote for someone and they forgot a $15,000 thing that they had, which drastically adjusted the quote that I gave them, right? But if they're ready to get a pre-approval done, I don't need that because it will pull in from the credit report. So the only way I would need that, the only debt I would need that's not on the credit report is if they have to pay child support or alimony. And that's a whole separate question on the app. And then assets, I tell them, leave that blank unless it's something you're going to sell for your down payment or pull a loan against for down payment. So you can pull a loan against a property for down payment, and that is sourceable. And even a car, actually. We can use a loan against a car if it works with their DTI. That's a sourceable asset as well. So some things like that, some property like that works, but we don't need it on there unless they're going to use it as a down payment. So if they're going to sell it or pull a loan against it, then they can put that in there. Otherwise, they just leave that section blank. What do we have on time? For a bit. Okay, and we're doing 12:40. Okay. The minimum you should make sure that your loan officer has asked them is these things right here that we're going to cover next. Making sure their lender has pulled their financials. So have they actually, if they give you this pre-approval letter, the way that you make sure it's a pre-approval and not a pre-qual is you ask them, well, did they actually pull your credit report? Did they ask for your pay stubs, your W-2s, and your last 2 months of bank statements? We only need tax returns if they're self-employed. And then the conversations, did they talk to you about sourcing and seasoning? And that's why we need the bank statements. So asking them, sourcing means where is that coming from? So if that down payment is already in their bank account, it's been there for 2 months, we don't need to ask them where it's coming from. But if there's a new large deposit in there, the underwriter is going to request that they prove where that has come from to make sure there's no new loans that haven't been reported on the credit report because they're new. That's why they're looking at those large deposits on the last 2 bank statements. So seasoning just means it's been in there for 2 months. So yeah, your lender also should be calling you and letting you know they can't give you these details. They should not be giving you these details without permission, but they should be letting you know because this is your borrower too, right? This is your buyer, this is your client. So they should be letting you know where they're at in this process, what's going on. Have we had this conversation? Have they applied? Are we waiting for the docs? If you've gotten everything, how long is it going to take to get this pre-approval done? So they should be having those conversations with you as well. And then go ahead and ask, especially if you're a listing agent and you get a pre-approval letter, you should be calling that lender and asking, have you done all of these things? And have you ran it through an automated underwriting system? So that has the Fannie Mae and Freddie Mac guidelines in there for whichever program that they're using, that they've told you they're pre-approved for, conventional or FHA or whatever. And then an automated underwriting system is a computer system that has all of those guidelines and regulations in there. So it's like a computer check on everything that the loan officer put in. And if you get an approved eligible on AUS, that's a golden rock solid pre-approval. There is still some things that can come up in underwriting, and a good loan officer will know what to look for and can check, with underwriting ahead of time. But if they've been around through AUS, it's pretty solid and you should feel pretty secure in that. And please don't hesitate to ask the lender these questions. They owe you that information because the person's home is on the line, their earnest money is on the line, whether your transaction closes is on the line. So if they're not willing to talk to you about that, I would not accept that offer. But that's up to you. Because maybe it's the only offer you have, but do not be afraid to call those lenders and ask these questions. They should absolutely be willing to have these conversations with you. Sometimes reserves are required. Who knows what reserves are? I think I already mentioned it once.
Like enough, some saved up in the bank that if you needed to, you could pay.
Yeah. So it's not always required, but there are some situations where it comes up in the increments where it will say 6 months of reserves is required. That often happens if it's an investment property, but sometimes it does happen for a primary residence. So if that's required, we're going to be having that conversation with the buyer and seeing what they can do to create that if they don't have that already. Calculating incomes, my favorite. Acceptable job history versus not acceptable. So again, somebody mentioned that if they just started being self-employed, that 2-year history starts over. But if the reverse is not true. So if they go from being self-employed to a W-2 job, we can count 2-year history. But if you're starting from a W-2 to a brand new self-employed business, that 2-year history is going to start over because they're not sure. It's going to take some time to see if this is a viable income source, right? A viable business that produces income for this person. So that 2 years starts over. And I'm working with someone right now. Actually, I'm always marketing if you don't know me yet, but they got an Uber driver on the way home from Orlando and they spent my 40 minutes in the car talking to him about real estate investing. And so he came into my office a week later and we were calculating his income and his tax returns. And he doesn't have, most self-employed people do not show enough income either. So they're going to need to be looking at some of those non-QM products, which have higher rates and fees. So he was so excited about real estate investing that he's going to go and get a W-2 job for a few months until he qualifies and gets a property. And then he will shift back to being an Uber driver. And that's okay. That actually works. But the reverse is not true, right? So if someone had a W-2 income, but they want the freedom of driving Uber or whatever it is, you're going to have to wait a couple of years. And so we're having all of those conversations. How long must a borrower be on the job? Again, they can be brand new. They can have one pay stub. We can qualify them off of the employment contract if they have all of those other qualifying factors. They have the 2-year history and things like that. They need to switch jobs during, oh my goodness, please don't. But if you have to, we have had this happen. We have had people switch jobs mid-contract, which we're talking 21 to 30 days, right? You can't just wait, but sometimes they can't or won't. So we can, if they have, because our processor, is going to be calling and getting what's called, we nickname it a VOE, verification of employment. Obviously, we need to confirm with this employer that this person works here every time. There's no getting around that. They will have to fill out, their employer is going to have to fill out a form for us to prove that they work there. Sometimes we get a phone call or the call back saying, I'm not going to fill this out. They put in their 2 weeks notice. So that's fun, but we call them and I ask them, and they're in the process of getting a new job and starting it the day after they put in their 2 weeks notice. And that actually works if we have the employment contract. But sometimes the underwriter, it depends. That's a tricky situation. The underwriter might require the first pay stub. And so we might have to extend at that point in time. So communication is huge with our buyers, right? Making sure. So we're always having this conversation ahead of time. When we give them the pre-approval, we'll say, this is based on your financial snapshot today, your credit report today, your job history today, your monthly income today, your debt to income ratio today. If any of those things change, so please don't change jobs. Please call me first if you must. Please don't increase your debts, right? Because your debt to income, if your payments go up on your credit card, you're no longer going to qualify for this amount if you're looking at your max purchase price. So we're having all of those conversations, and you guys, that's why I teach these classes, so that you can back that up as well, right? Especially around Christmas time. You wouldn't believe that people will go and get a new credit card to save the 20%, deals at Christmas time. Like if you open a new Kohl's card or whatever it is, you get 20% off your purchase today. That one thing can kill a deal. And it's not the amount, because if we can prove they can pay it off, it won't affect their debt to income ratio unless they put 5,000 down and they can't pay it off. That could be the thing. But if they open a new card, it drops their score for 6 months. And
hey, can we just address like how crazy it is that you can play the system with a job like that? You can just go get a job and like qualify and then quit your job and like, but yet if you're self-employed, it's like impossible to get qualified for anything. That's absurd, but yet that exists. That's crazy.
it does exist. And that's, again, why you want to work with a good lender, because we know the workarounds, right? we know how to help. We know where those gaps are in the system, and we know how to help people get qualified to fit into those gaps that they don't qualify for. And what is, again, that's the compliance issue.
So just get a job for a month and you're golden. Quit your job,
You
do whatever the hell
could.
you want to. That's awesome. Love it.
You could, but we're also having those conversations about, you better be making, sure that you can make these payments for at least 7 months, or I have to pay it back. So you can bet I'm having those conversations with them. I will give them the workarounds if they come up against a wall, because that is my job. That's why I study and find out all of those things, but I'm also going to make sure it's compliant and appropriate. It's actually going to help them and us, not hurt them. Not going to do it just to get a deal done. Might help you, that would actually hurt me.
Just like 2006, it's good stuff, no big deal.
Yeah. No, we don't want any of that happening. So if it's appropriate, and I will give them workarounds for walls and challenges, but if it's not, like something like that, if they're just doing, why would they get into a mortgage and they're just going to have a foreclosure a month later, right? Because, and I'm going to get to bankruptcies here in a minute and foreclosures, but if you file bankruptcy, you can get a loan in as little as 2 years. And if it's 13, you can get it almost immediately after discharge with Freddie Mac, unless there was a foreclosure or even deed in lieu of foreclosure, and then you're waiting 7 to 10 years. So that's not something you want to take lightly. And I will.
No, so for instance, my brother-in-law, so he's self-employed. They don't have the bestest of history as far as like credit history anyways, but he makes really good money and he can never seem to get approved for freaking anything. So if he were to go get like an actual job for a month, he could start getting approved for something. I mean, can I recommend this to him?
I wouldn't if I were you. If your lender looks at his whole background and his history and his income and his bank statements and his credit report and then recommends that, possibly, but I would not recommend that if I were you and didn't have the whole picture. We call it like forensics, financial forensics on our side of the track.
See, a little
We're looking
CSI.
at all of that before we would ever recommend something like that, because that puts them in a really bad position. It's not just that if they miss a payment, if they go into foreclosure, if they sell or refi within 7 months, your loan officer is paying that back to the lender. I don't know if you guys knew that, but we're taking a risk vetting these people out financially, and it's huge. It can be $10,000 or more. So we're not going to take that lightly. We're not going to get a deal done just to get a deal done.
Nobody wants
Right?
chargebacks. Yeah.
Yeah, we don't want any of that, and we don't want it hurting them. We don't want any of those.
I mean,
One missed
he
mortgage
can more than
payment.
afford the payments, like, which is also crazy. Let's talk about that in the lending industry, how you can have rent and your rent can be $2K plus a month, but you can't go get a mortgage for more or less, or let's say less than that. But yet I've paid rent for the past, 15 years of my life. That's just crazy. It's crazy how skewed things are. But anyways, he can more than afford payments. He just doesn't have the best history. So anyways, it's been really difficult for them to get into something because of his business hurting his credit history. But as far as money he makes, he can afford the payments. So if he were to able to, you still wouldn't recommend that to go get a job for a month or two, even though he could easily make the payments.
It's possible. I would personally want to run through all of his scenarios with him and do all of those background, financial checks before I would recommend a specific workaround for him or a specific loan product for him. So it might be that I would recommend that, or it might be that I would recommend a DSCR loan. I don't know until I talk with him and run through all of the scenarios to meet his needs and his goals.
Okay, love it.
I got a question on that.
Yeah.
As far as payment history, the rents don't count, right? You can afford the.
They don't count, yeah.
What about somebody that already has, owns a home and has been making payments on a mortgage, even a seller finance mortgage, and they've got a 12-month history of making a mortgage
So
payment?
that helps their credit score, but it doesn't help the debt to income ratio. Those guidelines are Fannie Mae and Freddie Mac. It is conventional is 45, FHA is 45.55, USDA is 29.41, and VA doesn't actually have it as bottom front end and back end DTI. It's just whatever we can get to run. We've seen it as high as 57, but we're also vetting out all the other ways to make sure that they can pay. Because again, we don't want, chargebacks, we don't want the house, we don't want hurting their future ability to buy a home, not just foreclosure, but even one missed mortgage payment, they can't buy a home for a minimum of a year. So all of those things, so making your mortgage payments on time is going to help your credit score. But when they go to apply for a new one, that is not calculated into what you can pay. It is your current debt to income ratio. So they may have a current mortgage payment of $2,500 and they've made it every month on time flawlessly for 5 years. But they went and got a new car that's $70,000 and they now have a huge DTI, and then they go to apply for their next mortgage. They can no longer pay $2,500. They can't qualify off of what they've been paying. They qualify off of the guidelines. Your debt to income ratio that's not something that can be messed with on the conventional FHA, conventional products. You'll have to look at the non-QM products at that point in time.
Hey, if they missed a mortgage payment though during the whole COVID thing and they got that mortgage relief, they can still apply and they're good, or they're not?
Okay, sorry, say that again.
So during the whole COVID, you can skip some mortgage payments
Forbearance.
thing. These guys still can apply for another mortgage and they're good. You were just saying if they missed a payment, they can't get a
Oh,
mortgage.
if they were in the forbearance period, yes. Yeah, they're fine. If they missed payments that were reported on their credit report, if there's a missed mortgage payment on a credit report, we are going to have to, if it was forbearance and that was accidental, we will have to challenge that and get it removed before they can qualify.
Did they have to do something with their bank to say, hey, I'm missing this payment because of COVID? Or what if they just missed it, but they happened to fall in that time?
Every mortgage lender had a different system for that. So they will have had to have communicated with whoever their service provider was at that time.
And if they didn't, they're screwed.
That is unfortunately true, but I'm happy to have a conversation with them on how they can move forward. Okay, keyword number 4. So three, two, no.
This is number 2.
Keyword number 3 is it? We already got our food here. You're so early. You guys are missing out on the food here. So keyword number 3 is income. Keyword number 3 is income. I know it's a long drive for some of you, but it's so much fun in person because we stay and we eat and we chat, and you guys miss that. So come next time. I'll be here every month. Okay. Variable income is going to have a 1-year history, like I mentioned before. So if someone wants to count like commissions or a second job or something like that, we're going to need at least 1-year history of that before we can count that. People can't just go and say, oh, I don't qualify for enough, I'm just going to get a second job and then I can qualify. It doesn't work. We have to show at least 1-year history of having that second income.
Would this be like a side hustle?
Side hustle, yeah, they're so popular right now. But here's something though. Here's a nice compliant workaround for that. So we can't count it towards their DTI right away. But if they get a side hustle that has a big chunk coming in, you can put that towards your down payment and get a bigger purchase price that way. So I had one guy that could only do, I think it was about $450, and he just wanted a home that was $600. I mean, he just would not accept anything less. And he made $400,000 a year, but he was self-employed and that income was new. And so he was really frustrated thinking, I can afford more. This is frustrating. And so he got a side hustle selling exotic puppies. They made $90,000 in 3 months, and then more and more and more. So he did get his goal eventually. But yeah, we can't count that towards the monthly.
Were they actually Siberian tigers or something? That's crazy. 90
down payment, and we did have to source every single puppy sale, but we did that and they got it and we're done. So that was a pain, but we will do those things. So minimum credit scores needed, I already covered that. Oh no, I didn't. I did the best scores. So minimum Fannie Mae and Freddie Mac guidelines actually do say 580. However, good luck. So, because the things won't run through the automated underwriting system, right? The things that happened that made that score down to 580 or 600 or even 620, we're just not seeing them run. If they've got mispayments, if they've got collections, those are things that still won't qualify. Now, if they had a bankruptcy and it's been discharged And they're doing, they've made every payment since and things like that, and it's at 620. That's a rare scenario that we can and have seen run, but most of the time, way more often than not, if their scores are that low, it's because of unqualifying factors that have made their score that low. So we'll work with them, we'll do what we can, we'll give them a plan of action. If they're at that, for us, we won't even touch 580, we won't go below 600. But if they're at 600 and it doesn't run through AUS and they need a little bit of help, we'll create a plan of action for them. We will nurture them. We will stay with them. Again, me and Mike and our whole team, we're in this for the long haul, and we don't drop anybody. So we have our in-house system called Wayfinder that will give them little tips and tricks to get it up quickly. Our standard for that is 30 days from when they do all of the things we recommend. So it's dependent on them following the plan of action. So we'll give them the things and we'll say, and then call your credit cards and ask them when they report, and 30 days from the last one. That's the traditional system. We can do it faster. We can do it in 3 days. If we do a rapid rescore, they do have to pay an additional $150 per trade line if they want that. So that's up to them if they want to do that. If they want to move forward that quickly, we can offer that. If it's severe, like 580, or recently I saw someone down in the 400s, that's a way beyond what we can do in-house. And I do have, like I mentioned before, reputable partners that I send people to because they fix them and send them back, and they keep your name and my name in front of them, and they do it to help them learn how to buy a home. They have a home builder system, home buyer system built in. It's geared towards getting a mortgage. Don't let them go to some online person that just destroys their credit and ruins their chances. There are some that actually recommend stop making all your payments for a year, and then they will be forced to negotiate with you. Okay, if you want to save a couple $100 and never get a home, if that's your goal, fine, use that system. But if you want to buy a home, don't go that route, right? So we have some reputable people that we work with, and we know they work well because we wouldn't keep sending them people if they didn't. One of my partners even offers a money back guarantee, and in 10 years, she's only ever had to give one. So please work closely with the right people if your buyers need that. Let's see. Oh, can you give a concrete? Oh, yes. Did I already answer that for you, or you still want me to answer that? The definition between a pre-approval and a pre-qual? Yes, you still want it? Okay. Pre-qual is, yeah, that's what I was saying, why you guys want this education, so that you can be asking the lender. If you're a listing agent, be asking the lender yourself. If it's your buyer and they've come back from a lender you don't know, be asking these questions, because a pre-qual should not have been done since 1980, but they still happen for some reason. And it's when a lender just takes the phone call and the buyer just says, yeah, I think I make about 5,000. Yeah, I think I pay my minimum payments for 200, and just basic numbers over the phone, verbal, without checking anything. And they say, okay, here's what you could qualify for if everything you say is accurate. And they will give you that letter, and you don't know because you didn't ask and you didn't know. So you haven't dealt with that before. Call them and ask them these questions. Have you looked at all of these? Have you looked at the pay stubs? Have you looked at the W-2s? Have you looked at the bank statements? And have you run it through AUS? Ask those questions. Do not be scared of that lender. You have the right to ask this. It is actually, I think, your duty to ask this, because you need to make sure that this, your buyer is in good hands, and that this deal is not going to fall through, and they're not going to lose their earnest money, because that's usually all the first-time home buyers have, and then there goes their chances to buy something else. So that's the difference. A pre-approval, the lender has verified all of those income sources, and they have ran it through AUS. We'll even take it a step further. Like I mentioned before, the beauty of having in-house underwriting is that if I do see someone with a tricky issue, variable income or anything like that, or someone is in a really competitive market, either one of those, we will go ahead and put them through underwriting ahead of time. The pre-approval takes longer. I can't do that same day. It's like a 1 to 2 week process, but then we give them security plus certificate that we put on top of the pre-approval letter. You present that to the listing agent and we say, we guarantee them to close in 10 business days or less. They've already been underwritten. This is now subject only to appraisal and title. And we guarantee their earnest money up to $10,000 at that point in time as well. So we will offer that service for anyone who is in a really competitive market or has tricky self-employed variable income. Oh, wait times. You guys want to know this? Screenshot this one. This is the wait times for bankruptcies. VA is going to be 2-year wait time after a bankruptcy. USDA is going to be 3 years. Conventional is 4 years if there was no home included. If there was a home included, it's going to be 7 years. FHA is a 3-year wait, unless it was a Chapter 7 with no home included. Do you guys know the difference between 7 and 13?
Besides digits.
Okay, that's fair. 7 is a clean slate wipe of everything. 13 is the repayment structure. And this is important for you guys to know, because these wait times do not start until discharge. With Chapter 7, when they wipe everything, the discharge starts a lot sooner. With Chapter 13, it's usually because the buyers have a good heart and they just want to be able to repay, but it puts their home buying journey out much further because the discharge doesn't start until everything's paid off. And so more often than not, if someone really wants to buy a home, they end up going from 13 back to 7 anyway. And then that discharge time doesn't start until they've filed for the 7. And then they went through the costs of filing twice too. So not that I want to tell people not to pay their bills, but this is one of those forensics financial things. Again, it's like, what are your overall goals and objectives? What is the situation and what is in the best interest of everybody? So that's just something to consider between those two. But the wait times don't start until discharge, and 13 does not discharge until all of those payments have been made. Okay, cosigners. Who knows the difference between a non-occupant cosigner and an occupant cosigner? Adam, you're talking, but you're muted.
I've done too much talking. I'm assuming one lives there and one's not going to live there. So grandma signs on one and a spouse signs on the other. Yep.
So non-occupant, yeah, someone that's not, and a spouse is actually a co-borrower. That's the only difference between co-borrower and co-signer is co-borrowers are married.
A co-signer would be like Uncle Fred in the basement.
Someone renting the basement?
No, Uncle Fred in the basement.
Oh, Uncle Fred who lives in the basement, that would be a co-signer. So yeah, if they're married, they're considered co-borrowers and they're on the same loan application. If it's any other situation, more than one person on the loan, they're considered a co-signer, and we have separate applications, but we link them together.
So if somebody's not married, but they live together, like happens a lot around these parts, are they considered co-signers or co-borrowers because they're not married?
They're co-signers. And that's fun because I'm having a conversation, a really raw conversation with them because of this poor guy. I just had to refinance him out of a 3% interest rate into a 6% interest rate because he bought a home with his girlfriend and then she's now living with another man. And so, and he wants to keep the home and his payments are now $400 more a month because he had to refi to get her off the loan. So, and if they're not married, it's a cash out refi, which has higher rates and terms. If they're married and getting divorced, they can have a non-cash out refi. They can have a rate and term, so they don't have to pay those higher fees. But if they're not married, they have to pay the higher fees. So I'm going to be I'm just going to be real with them and just let them know that all of those things ahead of time too. Like loving and supportive and great, this is awesome, and do your thing. But also just know this, that if you're not married and you do go to sell or refi or whatever, here's what it looks like. So it is a little bit different. Non-occupant co-signers just don't work for VA and USDA. Who can co-sign? So family members and other non-family members can too. And this is an investment strategy also. A lot of people like, oh, this young people, I'm doing this strategy a lot with young people who can't afford their own place. First-time homebuyers have kind of been priced out of the market, if you haven't noticed, unless they have a cosigner or some strategies. So this one works really well for those who aren't married yet. Instead of renting, you know, a little single family with 4 other people, or a dorm or an apartment or anything, I'm like, why don't you guys just go and buy your own condo or townhome together, and then be building the equity, and then in a couple of years, then you can sell and split or rent it out and continue to be co-investors. So we can have up to 4 co-signers on one loan, or 8 if they're 4 married couples. So that is one strategy to help some first-time people start to get into the market. Might not be optimal for young families with kids, but they can have non-occupant co-signers on FHA and conventional. So that's where mom and dad can come into play. Or I've had the opposite. I've had an older gentleman who had moved here from out of the country, and so he had a great job, he had great income, low debt, but no credits, you know, score. And so that's a tricky one. So co-signers don't help with credit scores. We still have to use the lowest middle score of all co-borrowers and co-signers. So it will help with income and not with credit score. Sound like you have something to say. You're like folding your arms. I'm talking to you, Adam. Mouth moving, okay. All right. Another keyword. All right. Let's do cosigners for keyword number 4. Cosigners. So helpful right now. So I'm going to go to the upside and the downside for the cosigner, some of their concerns and how to alleviate some of their concerns. But they do need to understand this is where you need to trust your lender to have these conversations with your buyers and their cosigners and let them know they are an owner of this property. So they are going to be on the loan and they are liable for that loan for the life of the loan. However, it only affects their DTI for 1 year. So the concerns there are if your son or your daughter or whoever it is stops paying, yes, you are liable for that payment, and yes, it will affect your credit. The other concern is, well, what if I want to go buy a new home and now my debt to income ratio doesn't qualify because I co-signed for my son or my daughter? The nice thing about that is true only for 12 months. If we can prove that the occupant borrower has made the payments for 12 months, then it no longer affects their debt to income ratio and their ability to go buy a new property. So that's the nice part about that. But they will always be liable. And so that's another conversation, you know, do you trust this person to make these payments? And you might want to just make sure you're checking your credit report every once in a while just to verify that. Because you don't want to wait till you get that late notice in the mail and then you've already got that on your credit report and then you can't buy for a year and it hurts your score for 7 years. Any mispayments will be on your credit report for 7 years. Acceptable sources of down payments and closing costs. Can we use puppy sales? Yes, if we source the sales. So everything, you know, we had to get papers and documents and all of those things, but we can do it. Money in the bank account is obviously the fastest and easiest way. If we can show that it's been there for 2 months, then we don't have to ask where it came from. Mike recently did a loan for somebody who had saved $20,000 literally under their mattress in a box under their bed. Can we use that? No, cannot use cash because there's no way to prove to the lender that it's not a new loan, because new loans will not show up on your credit report for 30 to 60, sometimes 90 days. So that's why they source them and season them for 2 months, is to make sure you're not getting out a new loan, which would then affect your debt to income ratio and your ability to pay this mortgage. But for Adam's sake, I am going to share a workaround for that. If Bob does have $20,000, and we did do this scenario under his mattress, and he qualifies for conventional, we can give it to a family member who then will give it to him as a gift. And we can use a gift fund for a down payment. And if they're conventional, we don't have to source it. We just need a gift letter. If they're going FHA, we do have to source it for 30 days. So we will have to, we would have to either wait 30 days or grandma or Aunt Sally or whoever would have to say, well, why do you have this $20,000 deposit in your account 10 days ago? Where did that come from? So just be aware of that. If they're
Pretty much negates the whole.
kind of does. So if it's FHA, they're gonna have to wait 30 days, but instead of 60, but they need to put that in a bank account sooner rather than later, basically is what we're saying, if they've been saving up cash. So proceeds from the sale of a home, even if it hasn't sold yet, doing that right now with somebody. So the home is for sale. We have a pretty good idea of the amount of equity that they have in there and the amount they want to use towards the down payment. We're doing a lot of research and a lot of vetting out on that, and now they're under contract with something here. So when the home sells from California, we can wire that down payment directly from their title company to our title company. And roll that immediately into there. There's some different things, or if someone sells it sooner before closing, they can do that. We can source that quite easily, but we can do that before the home has sold. So that's a domino transaction, right? Where one is contingent upon the other. Loans against assets. So HELOCs are a very popular way to get down payments for your next investment property. And it's fine as long as the payment works, right? As long as that works on your DTI, you can take a loan against an asset. You can also do that with cars and RVs and trailers and things like that, as long as it works with your debt to income ratio. Gift funds from grandma or Aunt Sally or whoever, they're supposed to be from family, but underwriting doesn't usually source that in too much detail. So we're like, yeah, it's the second cousin, once removed family. Does the underwriter care? Usually not. And then we've had gift payments come in from employers too, for like relocation fees and stuff like that. So it can come from some different sources, but the requirement for conventional is just a letter stating that they will not have to repay this. FHA is going to require a 1 month's bank statement to source and season that. Gift of equity from the seller if that's family. So they can roll equity from one property in another. That's a little bit of a tricky one. And trust funds too are a little bit tricky, but we can do those. We can even do crypto if they can cash it out and source it. So there's a lot of unique situations that we can run through scenarios and let you know if this will work. If not, if you have specific questions, just call me and we'll have that conversation for any of those scenarios. You cannot use unsecured loans. So you can't go get a loan to use a down payment to get a mortgage. You can't use credit cards. You can't use cash under the mattress unless it's been, you've put it in your bank account. You'll have to wait 2 months. Or if you give it to grandma to give to you, then we can use it a little bit sooner. You can't get a loan from a family member for your down payment. It does have to be a gift fund. What time are we at? Oh, we're out of time. Okay, Val. Here's your zero down programs. If you guys, I'm going to give you keyword number 5. And if you guys want these slides, just email me and let me know. I'm happy to send these to you. I mean, you'll have the recording, but there's a few more things that I didn't cover. So I'm happy to send you the slides. I'm happy to hop on a call anytime, or we can email or text if you have questions anytime. So I'm going to get to the last slide. I'll give you keyword number 5 is, let's just say zero down. That's 2 words, but wow, I missed a lot. But here's the QR code again, if you didn't get it on the first slide. So you fill out those keywords. Keyword number 5 was zero down, if you missed that. So fill that out, please, immediately. I can get that banked by the end of the day if I get everybody's in on time. Yes, I'd be happy to send you a copy of the slides because there was a few I didn't get to there. I always end up talking and chatting about scenarios, but that's important because that makes it applicable. So before we let the most amazing IBEX presenter everywhere, Mr. Chad, come up here, tell you all about his amazing service, does anyone have any questions about this that's pressing and can't wait for a phone call?
You guys having trouble with this?
Oh, let me try
Yeah,
it, really?
It's like
someone else's info on it.
Yeah,
Oh, no.
it's saying we're not using the right version.
And
Okay,
it says the
first
name
one.
of the person, their.
Try that.
Adam, like, check your phone.
Yeah.
Yeah, we got Troy's info.
Okay, try this one. So you're just gonna have to email me all that.
Same one.
Okay, I'm gonna, everybody just email me then. Dang it.
It's given us the other people's stuff. They filled out.
That's so weird. I don't even know how that's possible.
Holdwell Bank or something.
That must be your.
Okay, all right, everybody email me then, and yeah, I'll get that all fixed. Happen. I've never had that happen before. I don't even know how you can send out the editable version
Seeing the answers from those that did
from the
it.
other person. Okay, well, fun. I have all
It
the,
looks like the questions are still there. It's just filling the answers of the other people.
if
are
you send
filling.
me the registration
Mhm.
form, I can also
Yeah.
email the right format to, so either email me at dhart@shmloans.com. And if anybody missed this email address, I'll email you that Google form, or anyway, just send me the keywords, your first name, your last name, your brokerage, your license number, and I can get those banked for
Will you
you.
give your email address?
I think I have it.
Oh,
Right.
you do. Okay.
Yes, dhart@shmloans.com.
What did you want us to think of for first, last?
First name, last name, your brokerage, and your full license number. Those are the things I need to bank your hours, and then 4 of the 5 keywords.
Question.
Kathy, do you have a question?
Yes, I put it in the chat, but I think you might have not seen it. Are you,
Oh.
you do loans in Washington State?
Not Washington, Idaho, Colorado, California, and Oregon, and Utah.
Okay, need to get in Washington, Spokane specifically.
I would love to. I'll work on that. I was
Okay.
trying to work on Florida, but they want us to have a brick and mortar location and someone living on site.
I'll do that for you.
I know, right?
Thank you.
I
Thank you.
know. Okay, all right, let's welcome Chad.
Thank you.
You are a rock star. She is a marvelous presenter. You truly are, Debbie, and you're humble. That's what I love. Hey, yes, it is. I love that about you. Hey, all of ours out there on, what is it, Zoom today?
Zoom.
Hopefully I got no boogers hanging down or something. Hey, I've got these half severed goat legs. Does anybody want one? Stickers? Jeff, yes, thank you.
Okay.
You didn't say yes, but I was feeling like you wanted to say yes. Does anybody else want one?
Sure.
I've got the other ones too. Did you guys ever get these ones? The Ibex, the really pretty mountain scene ones? Everybody wins today. If you want. Do you want one, Jeff?
Yeah.
Put it on your, it looks like you got a place on your mug there for him. You want the goat leg too? Did you want some back there? Yeah, Debbie, you want some?
For sure.
I'll be quick, I promise. This is the longest part of this. Stickers, it's just a problem. Hey, real quick here, guys. Did anybody watch the World Baseball Classic last night? So disappointing. Anybody on Zoom watch the Baseball Classic? Adam, you did, dude? He doesn't want to answer. Anyway. He's just, I'm embarrassed him. I apologize. Okay, so here's the thing I was thinking when I was watching. I'm a huge baseball fan. Okay, and it came, the Japanese and the Americans were playing last night for the World Baseball Championship. And so it came down to the last, it was 3-2 for Japan in the 9th inning, bottom of the 9th. Okay, Americans last up. Mike Trout plays for the Angels. On the other side, pitching was Shohei Ohtani. He plays for the Angels too, but he's playing on his natural team for Japan. And it was down, it was full count 3-2. Okay. That's that part of it. Okay, did you see it? Oh my God, it was awesome. I'll tell you why I'm telling you this in just a second. So Shohei Ohtani throws, it's like a slider. He strikes out Mike Trout and they win the championship. So it got me thinking, I'm like, man, this is such a competitive sport. And I'm in a competitive environment, right? I think there's like 25 home warranty. Look at all these over there. I mean, there's a ton of them, right? So I'm thinking to myself, what are our competitive advantages? And so I'll give you 3 competitive advantages today. And you get to win a shirt if you answer the questions right. Doesn't that sound good? Do you have a couple? You can win another one, Debbie. Yeah, give them away. Okay, so here's the first question for y'all. Okay, So one of the things that I think is super important is speed of service, okay? The amount of time it takes us to be able to handle service requests that come in, both when the homeowner calls in and our contractor to get out and take care of them, okay? So we answer the phones in 14.1 seconds. I think that is tremendous. Your clients are not waiting when they call in to open a service request with IBEX. The next thing that I think is hugely important is 65% of the time we're taking care of service requests same business day. Nobody else can say that. We want to make sure that they're getting taken care of very, very quickly. The rest are taken care of in up to 30 hours. That's our average time to get things taken care of. The second thing that I thought was a real competitive advantage for us is our contractors. Here's why I say that. I think we're the only company out there that actually has a sister company where we employ our contractors. All the service requests that we get are handled by our team, no third-party vendors. And the reason why that's important is because we control how they look, how they appear, when they go out, what their schedules are, and they're our first priority. Third-party vendors, when a home warranty company calls, they are not their first priority, okay? I'm gonna tell you that. The money's not there for them. So we decided to look at it differently so that we can take care of our customers in the right way, okay? And then finally, I would say our coverage. I think it is absolutely fantastic. So we cover the HVAC, electrical, plumbing, appliances, all the kitchen appliances, the washer, dryer, garage door componentry in one cool plan for $600. Doesn't that feel good? Okay, so that's it. Now you get to win a shirt if you remember. How fast do we answer the phones?
14.1 seconds.
Oh, Debbie, you're so what size shirt do you want, buddy? You just trying to use custom.
Large.
Really? Medium. Well, that work?
You can are-
Oh my gosh, we did too many smalls. Okay, there you go. Look how easy it is, right? So how fast do our contractors get out on average to take care of service requests? Oh, man, I had this whole presentation. I thought it was really.
That's why you have to answer a question.
You can answer.
Same day, same day. 65% of the time.
Awesome. What size are you?
Excellent.
You XL? Okay, I've got an XL right here. There you go, buddy. Maybe somebody doesn't want my shirts. That's what it is. I don't know. Okay, what's something that we cover as part of our warranty?
HVAC,
That's huge. I love that. What size shirt are you?
large.
Large? I do have a large here. Let me find it real quick. Now, the reason, let me see. Medium. Sorry, I should have had these sorted beforehand, but I didn't. There you go, bud. Doesn't that feel right?
Oh, yeah.
Does anybody else want a shirt? Yay, come up and get one. What size do you want? Medium.
You're gonna make her answer a question?
Yes, I will.
Oh, no.
This is really prime since you did it. On the next opportunity you have to recommend a warranty, who's it gonna be?
You?
Yeah. That was kind of a leading question. I apologize. If you don't want to, that's fine. There's 20 others that'll do it. Okay, thank you, guys. I appreciate it. I've got food there for you. If you need anything, let me know. Thank you, thank you.
Will you take it for us?
Are you guys okay to be in a picture with my ugly mug?
Make sure you get the cool like screen behind.